Everybody, it's Michael Martin. Thanks for being here. So I got a great email this week about what did I do early in my career that helped change my mindset. I do a lot of talking about how I did it as I got older, but what was a critical factor that I used or deployed when I was just starting out. Now, again, to set the stage, it was a different day and age. Commissions were a big deal. They were very expensive, and my account was underfunded, like 5K. If you remember on the live tab on the YouTube channel, I talked about how I used progressive exposure to build into my winners. Which is kind of aggressive, but also moving my protective stops so that I could manage the risk because the commissions were so expensive. If I tried to put on, 5 trades, for example, I could be down 5%. 10 trades, I could be down quite a bit of money in my account just getting eaten up by commissions. So that was a deterrent. So what I did was I took home the data and I looked at it and I said, okay, imagine if you're in this trend, again, it's after the fact, and mark everything to the market and see how you would feel at these different stages, because there will be pullbacks within prolonged moves. And I knew since I couldn't day trade or scalp, I didn't have the money for it, and the commissions were, again, punitive. What I did was I'd put buy stops in above the market. As soon as they got filled, I definitely put in my protective stops, even though, yes, getting knocked out for both a loss and the commission on top of it really was aggravating. But I'd rather be aggravated by taking a small loss than being despondent by sitting in something that could really blow me out and set me back quite a bit. And the one thing that I did in all of that, which admittedly was very trying at the beginning, was I stopped looking at my P&L during the day. Now, some of you already have a heart attack, thinking about that, because that's the first thing that you want to look to is, are you making money? And I think if you go back to the episode where I talk about doing the hard thing, in trading's experiential, but it's also about a process. You add risk and you remove risk. Now, you can use alerts to kind of give you the heads up as to when you might want to put in your buy stop above the market, this, that, or the other thing. That's for sure. But I think for a person who's coming into the business that hasn't done this before, that is looking for excitement or will get excited when they see they're making money, or will feel, depressed or sad or aggravated, whatever the feeling is for you when you're losing money, in real time, those emotions aren't going to help you without any particular type of training. Right? In other words, your emotions will end up getting the best of you, and that's exactly what you don't want. The best you can do is focus on your process. 5, 6, 7 times out of 10, you're going to end up losing money on a trade. That's just the way that it works. And then your goal then would be to pan for gold, not knowing which ones are going to go, right? That's why I said, just put your orders in, let the market come to you, and let the market decide which stocks you or options or futures you should trade by the orders that get elected. This way you can take the pressure off yourself of having to choose among, choose 1 or 2 names out of possible 10 or 15 that might be on your list. But by taking off the P&L, what I took solace in was that my protective stop was always going to knock me out. Now, in those days, it was a little trickier because there weren't alerts that I could set on my market minder to tell me that the market had appreciated. So what I would do is I would just check in on the price of the instrument, about once an hour. I wasn't looking for super high volatility names at that period of time, so it wasn't like whatever, the darlings of the day, the Magnificent Seven or Bitcoin or whatever. I didn't have time for that because I was busy doing my job that they were paying me to do. So I was kind of learning my craft in concert with, trying to be a financial advisor, because that was the only job that I could get. So by not looking at my P&L, I wasn't induced to take small profits and celebrate those wins. Like I know it validates you to take a winning trade. I know that. But now that you know that, you don't have to fall victim to it, right? Because now you know how to adjust your protective stop, right, as the market moves up. And you can use ATR full ATR, half an ATR. If it goes up a half an ATR, adjust your protective stop up a half an ATR. If it goes up another half, you'll be up a full. So then maybe then you move your protective stop to break even. I'm not a big fan of reducing risk all the time. I know people like this 2-for-1 trade, and try it, see if it fits. I just know that I wanted to be fully loaded as the thing was making new highs. Because then as we start putting in, new highs, going into new territory, maybe you're going to life of the contract highs, 52-week highs, multi-year highs, those things are harder to predict. And as you've probably seen, the folly of research, fundamental research, and that people's need to try to predict things or come up with price targets, you start to lose faith in humanity, because it's like it's a folly. And I realized that if I just sat on my hands, the things would move a lot further than I ever thought they could, and more than anyone would have predicted. And that happens especially around historic highs. So look at the charts and see some of those big mega cap names and see where they are. You don't know where the top is. So why get excited about taking a $10 move, right? How do you know it can't go 50? And then you have to do all this work again to try to get back in it. Again, if you're watching your P&L and you've never made $1,000 on a trade, the minute you see a comma and it's green, you're like, I got to take the trade off. And that, again, is like, if it feels good, it might not be a good financial decision. Now, there's an argument like, well, you can't go broke taking profits. But that's why when I do training with people, the first thing we talk about has almost nothing to do with trading, but everything to do with trading. And that is, what is your goal? What is it that you want your money to do for you? Like, I was super clear. Again, maybe I had this prescient understanding of things. I knew I was tired of working like a dog. I was exhausted physically. By the time I got to Wall Street, I literally had been working physically for half my life. And I wanted to now have white-collar jobs. I wanted to use my brain. Sometimes I didn't do that, but that's part of the process. It's like, it's experiential. You have to learn how to do it. And I knew I wanted to grow, my smaller account and give myself more breathing room so I didn't have to trade so aggressively. I ended up trading aggressively still because it suited my temperament and my personality, but I wouldn't have known that if I didn't try. And so if you find yourself wrestling with yourself, you're the problem, right? Because when you think about trading, everyone's like, I got to know, what's the chart? What's the scanner? What's the system that I should subscribe to? What's my Discord? What's the Telegram? And that's not important. What's important is your behavior. There's any number of instruments that are going to move and haul ass over this year. By the end of the year, you'll have 20 different names that could have doubled. And the question then you have to say to yourself is, if you're putting on a 0.5% risk unit and the thing goes up and you take it off, you make whatever 0.5% on your overall equity. So that might feel good, right? If one ATR, call the ATR $1, right? And your R based on that ATR is a 0.5%, and the instrument goes up, say, from 10 to 11. Nice, it's up 10%. You're only up a 0.5%. Now, when you net all your losses out, you see why you have to let your winners grow in an unbridled way. Because you have to pay some, for clearing, you have to pay the bid-ask spread, whatever it might be. Some of you might be paying commissions depending on where you clear and or the instruments that you trade. So you need the gains, the larger gains, to pay for all the losers and the costs and the slippage and the skid, so that that's what you have left. And I knew that inherently. Once it clicked, like, oh, this is a game of expectation. It's not a game of accuracy. I'm going to let my winners run for as long as possible. So that's why I took the data and put it in a spreadsheet and then looked at, like, okay, if this was my position and the market opened here, here's what my equity would have been, here's what my P&L would have been on a day, then here's what a pullback looks like. So that this was my way of paper trading, because they didn't have those simulators and the engines where you could back test. You had to do it by hand, which was a pain in the ass because it took a lot of time. And you would also find mistakes. But the benefit of my having done that, again, this was in the first year, is I get to process my feelings at home without any real risk on, to say like, okay, I can see where the trend went from here to here. It was a monster, 60-cent move in soybeans, for example, right? Which would have been, $3,000, which is again 60% rate of return because my account was 5K. The margins were low, and I was like, okay, if I could just sit pat, what would happen if I had a 10-cent pullback? Because I could see it on the chart, and I'd have to mark my account to the market and see like what would that have done to me? Would I've gotten spooked and shaken out of the trade? Because again, I'm looking at my P&L. And for context, that's a 10-cent move in beans over one day or several days is $500. So that would have been a 10% pullback. And I liked how the beans and the corn and the wheat were all 5,000 bushels. A penny was $50, which was also 1%. So it helped me understand risk that 1 penny was 1% on a rate of return on my account. So I went through the open, high, low, close of every day over the course of this move, and it's kind of like this kind of quasi back test. And I said, okay, if I'm going to do this, I need to thicken my skin, and I can talk a good game. Who knows how I'm going to feel going forward? But by not looking at my P&L, I didn't psych myself out of winning trades. And I let myself sit on my hands. And I know some of you are like, you can't take futures home. You got to be stoned. Well, pot's not really my thing, but I knew I wanted to amplify my cash, and I knew I wanted to delegate, right? Because part of being a manager is to stop doing all the stuff yourself. I knew I wanted to stop exchanging my time for money, and I wanted to let the market do the work. So that time and leverage were working for me. That's what it means to be like a business owner. I have other people who get self-actualized by doing certain tasks. They feel good. We support them. You create an environment that people can thrive, pay them fairly, give them bonuses, give them incentive, give them opportunity for advancement, listen to them, do 2% of the talking to generate 98% of the conversation, and build a good organization that way. So when I thought about building portfolios, it was the same thing. Like, I'm going to put the soybean trade on, I'm going to water it, and put a little sunlight, let it sleep at night, and let the trade nurture. Because humans are terrible at prediction. And if you find yourself, well, I got to put these indicators on, I got the MACD crossover, I got divergence over here, that might not be material. Despite the fact that you can see that, it might not necessarily be material in the grand scheme of things. I've had lots of moves, where I've had futures positions on for 4 months, the same trade. So don't tell me it can't be done. Like if you look at Market Wizards and any of those people from the first and second book, they weren't doing that trying to scalp the E-mini or the MNQ. They were position traders. They put on monster positions and let the markets do the work. And I think if that's what you want to gear yourself to, then you have to emulate their behavior. First of all, of course, the E-mini didn't exist back then, neither did MNQ. So you got me there. But the point is that you focus on your process and you'll get the results. Looking at your P&L without any training is going to psych you out of good trades, especially if you see small winners, because you want the validation. So did I. But I just knew that given the commissions, the taxes, like what was I actually walking away with? What was actually mine at that, for all the risk that I was willing to take, knowing that in futures, regardless of whether you're long or short, you have unlimited loss potential. So I was very, very aware of that. And at the beginning, I traded small. But I didn't let, you have to be careful with, and I said this in another episode, you really have to challenge all the conventional wisdom. Because when they say don't let a winner become a loser, that's contextual. I've had plenty of trades where I was in the trade, it took off, it pulled back 25% of the original move, and I stayed with it, and it continued to go. So I think, if you're a day trader, this probably won't, any of this stuff might not really make sense for you because, you're looking at your P&L from the get-go. For me, I knew I was going to trade futures almost like an investor and try to catch the bigger moves and let the market and the leverage do the work, because I was a tiny little player. And when the institutions show up, they can really push the market, in ways that can benefit me. Now, for those of you who aren't familiar with futures, when prices get higher or go higher, victims like to blame speculators. And it's kind of like Tom Cruise said in A Few Good Men. William T. Santiago was dead, and he shouldn't be. You got to put the blame on somebody. They're going to put him on the Tom Cruise's two clients. Tom Cruise is going to show them, Colonel Nathan R. Jessup. We all know how it ended up. In futures, it's the cash market that moves, and the futures market follows. That's how it works. The futures don't push cash markets. You think about it from the standpoint of OPEC, right? They're not sitting looking at guys who are trading the crude oil futures contract in New York and making those decisions. They know what they need from a production standpoint because they need the revenue from having sold the physical. Futures, if you need more convincing, you have to remember futures contracts were established to transfer risk. So they're insurance contracts. You insure your car, right? It doesn't increase the value of the car. It just means you can be indemnified if something happens to the car, right? So the asset is the risk premium that is attached to the contract, right? I'm underwriting the risk, so I should get paid once in a while for that. But make no mistake, if you talk to anybody who's in the futures business or commodities business, it's understood that the cash market moves first, and then the insurance market reprices things accordingly, depending on where the risk is. So I understood that very, very early on, and that's right off the Series 3, right? So that's not necessarily my genius. It's the way it works. But of course, people being victims, they need to blame somebody, and inflation comes from printing the money. That's the inflationary event. The inflationary event is the printing of the money. The runny nose of the cold can be higher prices for goods and services. So, people need to understand the economics. Back to the show. Maybe if you entered into a trade for a stock or whatever it is that you trade, put in your protective stop, knowing that as long as there's no error in the order entry part, that stop order is standing sentry to protect your cash. And if you're having trouble getting out of the, Mike, all I do is pull my flowers and let my weeds bloom, because as soon as I see a green print, I take it off, but I'm not so quick to take the losers. Like you've turned what could be a game of positive expected value into a losing business because the emotions are getting the best of you. Now, I'm human being too, but this is me doing the hard thing, right? So this is how I practiced what I'm now preaching, is I had to put myself in a spot where I could understand what the risk is and know that, like even in the sugar market where, in '05, it basically doubled. It went from 9 to 18. There was a period at the beginning, like from October through November, that it went sideways for 6 weeks, and I still had, my initial position on before then it went to 12 and I doubled, and then I added more above that. And I had 40% of my account balance in sugar margin, because I kind of think, like, if you can find of those 12 names that are going to double, I don't know that they're going to double ahead of time, but you have to dip your toe into the water, and you really only need one or two markets to have significant moves over the course of a year to make a big impact on your account balance, because the goal should be to grow your account. I bought a call option at $1.80 and it went to $3.60. I doubled my money. Well, no, you didn't. If your risk unit is 0.25% and you've doubled the option premium doubled, yes, for sure. But your risk unit was so small, you're only up 0.25%, right? And I understand that you need to balance and test the waters to kind of see, like, what's the optimum risk unit for you, knowing your level of accuracy so that you can get the expected value. You might want to make more money, but that you might have to invite, a 20-25% drawdown to kind of go for the gains that you are anticipating. And so that comes with trial and error. I knew that if I lost all my money, I was still going to earn it back from my job. So I set myself free and said, this is a practice account. And I didn't let that kind of fear, because I knew what I could fall back on. I already knew that I could make 100K working concurrently at the restaurant at night and the golf course during the day. But it was, man, it was brutal. There was basically no sleep from Friday night through Sunday night because I was constantly moving. And I also was kind of sunburnt in in the summers. So the I knew I could harvest another 10, 15K if I had to. I didn't want to take a step back, but I knew that I didn't throw caution to the wind. I just knew that I had to apply myself and believe in myself that I could figure this out. But I also knew that I couldn't take a blue collar mentality to the job, right? Which I kind of did at the beginning. I was putting in 12, 15-hour days, and I was like, now I'm taking a blue collar mentality to this white collar job. I don't want to put in those kind of hours. I know I want to own things and earn gains and earn recurring revenue. So I spent a lot of time looking at different asset classes, and I did even look at bonds and municipal bonds as investment vehicles, not necessarily to trade, but to eventually have once I accumulated wealth. And I remember in the back of my mind saying, like, okay, in those days, money markets were paying 5%. Money markets. And so I was like, okay, well, if I had $1 million and I had it even in cash, no risk, opportunity cost for sure, purchasing power risk on some level, but just for 1 year, I could make 50K, 4,000 a month. Now, when you do that, my rent was 1,300. This was a long time ago in Manhattan, and I had 1,000 a month. I didn't borrow a lot of money, but I did finance some of my education. So I had 1,000 a month in student loans and 1,300 for rent, and that was due every we call it the first of every month. So it wasn't insubstantial. And I thought, okay, well, imagine if I had $1 million from my trading activities and I could get to that point, I could buy or put the money in the money market, be completely liquid, earn all 50K over divided by 12 is about 4,000 plus per month. That more than covers my rent and my student loans. And then I have other money, to play with. Some of that might be taxed. You have to look at that, and then the alternative minimum tax and this and that. But the point is that I used that as a motivator to think like I could become wealthy enough where I could have bonds. When you buy a bond, you're lending money to the issuer, right? And they're paying you rent on your money. You become the bank. And I liked that. That was very estimable, and it made me feel good that I could be in such a spot where I could be lending institutions money. Again, I'm coming from having two Depression-era parents and having to learn financial literacy all by myself. So all of that stuff was on the table for me to kind of think. But I knew, like, if I got psyched out of being in trades, that I was kind of biting my nose to spite my face. And it wasn't like I could just turn the switch, right? Because you have to process your feelings around all this stuff. But that's why I took the data home, put it into a Lotus 123 spreadsheet, marked my positions, or what I think my positions would be for the style that I was trying to trade, which again, a lot of it is in that. If you go to the live tab on the YouTube channel, you can see how I was doing progressive exposure. It's a replay of a live stream that I did. And marking everything to the market, then I could see, like, okay, here's the move, here's the pullback in the move, which you could say is a drawdown, even though your account is still up. And then here's what happens if you let the thing run. And although there were, a couple of moments where you sit up straight and you're like, oh, wow, that's a big pullback over the course of a day, a couple of days, maybe even the week. If I could learn to not let those feelings sabotage my behavior process, then this is more money than I could have even thought of making. It was almost like a 13th month. That's how I looked at it. It's like, wow, if I had this position on and I left it, it would create 13. So then I started to think, like, how many new months, if I looked at my salary, how many additional months could I create from my trading, right? So imagine if you make, say, 6K from your job, can you make 36K over the course of the year and create an additional, say, 6 months where there's kind of two of you? There's the working class you at your job, and it doesn't matter what, you're still an employee. I don't care if you're an executive or if you're a peon. You're still an employee and you have to eat shit and do as you're told. I wasn't that kind of person. I don't have the right temperament to, I can be a good follower, but I'm too entrepreneurial. I want to do my own thing. So I never put myself in situations where I had to have lots of bureaucracy on top of myself. I wanted to be able to make my own decisions, and I understood that if I screwed it up, it was on me. But I had had enough success at that point to be able to count and rely on myself, very fast on my feet, was very resourceful. I wasn't afraid to, market and ask people for money and even ask people for help. The worst they could do is say no. So then as those things piled up, I was in New York. The tax situation is pretty strong. And so I had to figure, like, what's the best way to make money and also minimize the taxes as well. But mostly, coming back to the theme, not looking at my P&L allowed me to stay in trades for a lot longer than I was emotionally ready to. Because again, I can only anticipate where a move is going to go. I can't predict where the top is. Neither can you. And if you start looking like, well, there's a top here, it could stall, I might as well take the profits. Like, again, doing the thing that feels good might take some money off the table, but now you don't have enough risk on if the move continues to go. And I was ready, willing, and able to sit in the moves, even have pullbacks, being fully loaded because I was adding to my winners, and some of the numbers were substantial. Like, I got to a point where the account eventually got to 10,000, and then there was a trade where there was a $2,000 pullback in a move that kind of kept going, and I was like, that's 20%. But I had the cast iron stomach for that, because I knew at that point, like, if there's a $2,000 drawdown, I knew that there was a $6,000 to $10,000 upside from a statistical standpoint. I didn't know that it was coming to me in this particular trade, but I knew it was possible. Why? Well, because I had already seen the data based on my position sizing and based on, some reasonable moves in the underlying prices, right? Because when you think about it, if soybeans went from 5 to 6, it's only a 20% move in the underlying. But if you have 5,000 bushels and it goes up $1 a bushel, it's 25K. So that's kind of what I was thinking. It's like, I need to get away from this small account because it's going to force me to make really stupid, small-minded decisions, which means take small losses and small gains. And so what you find yourself is you're shoveling sand against the tide, and you don't have any growth. And in those days, the only people who were making the money was the brokerage firm, because I was buying and selling and buying and selling. It's like, that's not going to work. Where can I get the best leverage, put the trade on, and stay out of my way, thinking of it like real estate? So I had to trade really, really small. I went to contracts that had very low volatility, which, again, isn't predictive, but I said, okay, here's what I know, here's what I can see. I can trade small contracts that don't really move, but when they start to move out of like multi-month highs, 6-month highs, life of the contract highs, those kinds of things, like, that's where things can go. Then I learned, like, okay, volatility increases near market tops. I got really good at understanding reversals and saying, okay, the market's moving, it's still going up, it's not reversing. What's volatility doing? It could be increasing. Okay, perfect. It is increasing. That means I'm going to deal with more wags, if you will. But until I actually see the reversal, that's now going to become my new exit point. You can trail structure, and I vacillate. If there's structure, I'll trade structure. If there's not, you have to use percentages. It might require that you move a contract or two off of your position, depending on which exit strategy is at hand. And then if you see the market spike and or go parabolic, now you have to be a little bit more proactive and kind of pick a spot, right? So you don't ride it all the way up and then give it all back. So you have several, strategies on how to offset the risk. given the prevailing market environment. But when you're just getting into your position, especially like for those of you, I know the day traders, probably this falls on deaf ears, but if you trade an MNQ for $2 a point, like, it's exciting to learn how to trade, and it's definitely exciting to make money. Once you flush that out of your system, you're like, okay, this is a business. And now I got to amplify. What's my, right? When you watch Shark Tank, they ask you, what's your margins? And so I wouldn't look at it on a per trade basis, because if your risk unit is a quarter point or half a point, and even if you doubled that position, it doesn't move the needle on your account. I needed to think more longer term, like how can I use time and leverage in my favor, so that everyone who comes into the trade after me has to pay me an admission ticket, right? So try that on for size. Again, trade small, try to think about what you're doing, and be mindful as possible. Because in the short run, everybody's lucky. Doesn't matter whether you're Tudor Jones or to the new person who's funding their account today. In the short run, we're all lucky. There's a lot of randomness. So there's no point in trying to internalize that and be like, oh, I had a green day, therefore I'm good, and or I did a good job. You don't know that in the short run. All you can do is stick to your process and follow your process. And there will be times when your equity ramps up, and there will be times when it pulls back. But if you know what you're doing it for, and you know what you want out of your account and how you want your trading to serve you, knowing that ahead of time is probably the single most important thing that you can figure out. Because self-knowledge and then knowing what your goal is for trading, you can pick your rate of return, you can understand what drawdowns would make sense for you. And then get this, instead of saying, I want to go do trading like XYZ person, if I know what the parameters are of what I want my money to do for me, picking a good trading strategy then becomes so much easier, right? Because certain rates of return go with certain asset classes and certain strategies. And so you make it a lot easier on yourself, rather than saying, oh, I saw someone on social media or someone belongs to this Discord. Oh my God, bitch, please with these things. And take it easy on yourself, because once you get clear about what your goal is, that becomes now everything has to be conjugated to your goal. Instead of coming to the market and be like, yeah, I've got all these charts and there's overlays and stuff, and I'm trading, whatever instrument I'm trading, I'm not going to sit back and just say, well, I'm going to take what the market gives me. I'm going to come in and act intentionally as an overlay on the market. Right? Because it's about you and your behavior, not about the instrument, right? So many people come to the market every day and they punch up the same tickers every day saying, fuck, I got 17 different strategies. One of them is going to work, because your account's underfunded and your trading strategy is more of a coping mechanism. So instead of coming from a place of power where you would say, here's what I need the market to do, there might be a few days where there's no trades for me given what I need my money to do for me, rather than me going out and seeking emotional validation from doing 1,000 trades and walking away, with a $200 winner, right? So it's not necessarily a kick in the head, but you have a lot more power because you get to control your behavior. One way to do that and not sabotage yourself is looking at your P&L all day and then internalizing the feelings by looking at those results. In the short run, you don't suck, and if you make money, you might not be good either. We're all lucky. It's all very, very random. Please like and subscribe, and get your free copy of the Inner Voice of Trading audiobook in the link below. See you next time.